Back with the market right here on 80 now, counting down to the policy now at 12 noon, 0.5% higher for the Nifty after what looked like it's going to be one of those quiet days. ONGC taking the lead, Z holding out, BPCL and IT as a pack is holding out in the green as we speak. On the flip side, some pressure from autos. M&M, Eicher, Maruti are all in the red, as is an Axis Bank. You've also got Shree Cement, DRL, the Bajaj twins, Titan. They're easing off just that wee bit. And even ICICI Bank is not doing a whole lot, just marginally in the green as we speak right now. But all eyes on policy. Let's welcome on board Chief Economist at India and Asia ex-Japan, Nomura, Sonal Varma, joining in the show right now. Sonal, hi, morning. Good to have you on the show. Our ET Now poll is suggesting that it's going to be a close call in terms of repo rate cut this time, but higher chances of reverse repo cut coming in. What is your expectation from the RBI policy?
Our base case is both repo and reverse repo rate will be left unchanged. I mean, there is some probability of a stealth easing if the RBI decides to do a reverse repo cut. But I mean, as they meet here in August, significant amount of easing has been delivered, and inflation is sort of causing a near-term challenge. And incrementally, we've seen some pickup in activity since the April lows. So it does make sense to actually wait and watch and assess the impact of the easing that has already been delivered. So unchanged on both repo, reverse repo is our base case view.
Sure. Sonal, if we look at the high-frequency indicators and the commentary from, various managements as well, demand weakness is certainly higher than supply disruptions. How is it that you're reading into the overall economic recovery?
Very similar to the picture that corporates are painting. Post the lockdown relaxation in April, there was in fact a fairly swift recovery in May and June. But since end of June and particularly in July, with cases picking up and more localized lockdowns, and also, even if there isn't government intervention, consumer psychology works in a way where the fear factor can cause activity to be slower. So there was a clear pickup in momentum in the last 3 months, but it looks like sequentially momentum is tapering down again. So there is a plateauing in activity. So that's something to watch out going forward, because clearly the path of COVID-19 will determine where activity normalizes for India. And at this stage, this is clearly a risk for the growth outlook. I would say not so much in the very near term. I mean, in the April to June quarter, which is already gone by, we are expecting growth to drop by close to 15% over last year's level. But beyond that, there's a risk of a much slower pace of recovery given the COVID concerns.
Sonal, good morning. Some would argue that the economy is clearly not out of the woods. Given the constraints what we have, do you think there is case for another stimulus coming from the government?
Yeah, absolutely. I mean, if one takes a step back, the inflation spike should be transitory, whereas the growth concerns are sort of more durable. And the banking sector balance sheet issues also mean that there's going to be a medium-term growth headwind. So the economy clearly needs support. And that implies both fiscal and monetary policy are likely to stay on the accommodative side. So even if the Reserve Bank does not cut today, we do think it's going to be a dovish hold. So the forward guidance clearly indicating that there is still room to cut. So our view is there will be additional cuts. We have about 50 basis point cumulatively more later this year. And as you mentioned, so far the fiscal support that has been announced has been quite limited. It's sort of in the survival fiscal support that has been provided. Given COVID is restraining activity. Additional support will be necessary for the lower income segments and for specific industries that are going to take much longer to get back to normal. And beyond that, there will potentially also be a need to provide more of a demand stimulus to get the capex cycle going. So, both macro monetary fiscal policies are likely to stay accommodative in India.
On the liquidity front, Sonal, what are your thoughts? What exactly do you think Reserve Bank of India can do to manage liquidity? And do you think a CRR cut should be around the corner logically, because when banks are parking so much of surplus liquidity with banks?
Well, given the current banking system liquidity status, CRR cut is quite unlikely. And also CRR is already at a very low level. So you want to keep some buffer in case there's a need going forward. So it's actually not necessary right now. RBI has already been quite accommodative on liquidity. And our view is the accommodative liquidity stance will continue because one of the preconditions for transmission is ample liquidity, because it takes time for banks' average cost of borrowing to come down and therefore their average lending rates to come down. So no additional measures, but continuation of the accommodative liquidity stance, which should enable more transmission, particularly from the banking side, the transmission which still needs to happen.
Right. Sonal, if we look at the transmission, SBI MCLR has been down about 85 basis points, which is good considering 115 that we've seen on the repo rate cut. What's your view on transmission?
So, in terms of the marginal cost lending rate, transmission has been fairly fast. So that reflects the impact of accommodative monetary and liquidity policies. Where we have probably not seen transmission is in terms of, adequate transmission yet is the weighted average lending rate. So from an overall outstanding loan portfolio of the banks, lending rates still need to come down. And this is something that will happen over a period of time as these loans are reset and banks' funding costs come down, which is why it's important for the RBI to keep its accommodative monetary and liquidity stance, because the lending transmission is still ongoing and it is not complete. The other aspect of transmission is between the better rated and the lower rated borrowers, particularly in the banking sector. So from the high-risk borrower perspective, lending rates perhaps are still relatively high, which essentially reflects the more credit risk that banks face for these specific customers. So I think clearly we have seen good amount of transmission, more in the money market rates, but also in the lending rates. But on the lending rates, our view is more is necessary going forward.
Sure. So now real interest rates have turned negative in the system already. Do you think this phenomenon could continue? And what is your own view on real interest rates as well as inflation dynamics going forward?
Yes. So the current negative real rate regime that we are in should most likely be transitory, because the high headline inflation is partly statistical, partly because of the supply shocks on food. And the expectation is that the more durable demand destruction will bring down core inflation, and inflation from a 6 to 12 month perspective will get back to the RBI's target. So while real rates are negative right now, they should turn positive, or at least going back closer to zero, depending on the measure we use going forward. So really the current negative real rate regime is transitory. But clearly there's been a shift in terms of the average real rates we are seeing. We've moved from a very high positive real rates 3-4 years back to now a fairly low real rates. And that, to my mind, clearly reflects a fairly weak economy that we have with output gap still negative, we don't need very high real interest rates because the demand for capital for investment is quite low. So low relative to history, but the current negative real rates is also not a steady state.
Sonal, what is your take on GDP? Several economists have already slashed their outlook for FY21. What are your thoughts there, and what else do you think the government can do essentially to create a demand stimulus?
Right. So for this financial year, we're looking at slightly over 6% contraction in growth. Clearly, the peak growth impact is going to be in the first quarter of this financial year, post which there should be an improvement. But the challenge really for India is the COVID curve. And with cases rising, we are seeing plateauing in the very high frequency mobility data, and some of the real activity indicators have been more mixed in July relative to across the board improvement in the May and June period. So it looks like a faster pace of recovery in May and June, and then sequentially growth slowing down. So still in a contraction zone despite incremental improvement. And I think overall growth challenges still remain. The bigger concern, of course, is the impact all of this is going to have on the banks, the corporate balance sheets, on labor market, what all of this means for potential growth, which is likely slowing down. And therefore, as you asked in terms of the demand stimulus. Now, from the monetary policy standpoint, there is room. Our view is that room will be used when inflation comes off. It's also important to fix the banking balance sheets. As the moratoriums get over and the NPLs rise, banks need to raise more capital. And resolution of the banking NPAs is quite important for the financial sector to be able to support growth. From the government's standpoint, the space is limited. But space will need to be created because particularly for the vulnerable sectors, vulnerable segments, more support will be necessary. And on the investment side, which is a more durable driver of demand, while not all funding can come from the government, creating the right business climate to attract more investment in infrastructure. There could be incentives for banks and other investors to invest in infrastructure, but it needs to be an all-round coordinated effort to try to boost demand going forward.
Sonal, a word on the currency market, which is that the dollar index has significantly weakened in the last couple of weeks. Other emerging market currencies have appreciated, but rupee is not really the best performing currency despite all the tall claims we have about forex reserve, our trade deficit coming under control, our current account deficit coming under control. There are concerns on fiscal deficit, but those are universal concerns. So despite a favorable tailwind, why is that currency has not strengthened?
The underlying balance of payment drivers are actually very positive, given India will have a current account surplus this year. So clearly it's been the Reserve Bank of India that has been very aggressive in buying dollars and preventing the currency from appreciating, which to our mind, sort of makes sense. And we do think RBI will continue to aggressively intervene because given there are limits to how much growth boost can come from monetary and fiscal policy, currency can be used to keep overall monetary conditions accommodative. So broadly, the fundamental factors for rupee in terms of the balance of payment dynamics are positive. But from the aggregate macro policy framework perspective, the Reserve Bank may continue to be aggressive and prevent the reserve rupee from significantly appreciating.
Well, Sonal, it was fantastic to have you back on ET Now. Certainly hope to see much more of you going forward. Stay safe and thank you for your time. Let's take a break. It's just one of those days where markets are not off to a great start, but sometimes a pause or a mild bit of consolidation for the index, for the broader market, for the pharma, for the IT, all is good news. The top draw today is across the board Tata Group of companies, and TCS there seems to be leading the charge. But barring that cluster of Tata Group of companies and few IT names, today it's not a market which is showing any rara signs of momentum.